Welcome back. This is Brian Kurtz with PremierRealEstateInvesting.com. Back at you with another episode in our Funding Fundamentals video series. And today we're going to be talking about small local banks. Now, for a long time, small local bank financing has been pretty much overlooked by everyone in the real estate investing world except those that were kind of, in the know. And the fact of the matter is that small local bank financing has always been around, and it's been a great resource for those that have taken the time to go ahead and get things set up with a small local bank and start using them as a funding source. For most part, though, everybody was using conventional financing and other types of financing, hard money and things like that, and so it was really not a popular type of financing source. But you're going to see as time goes on and prices continue to be at record lows where investors can make a killing, and you're going to see that the small local bank financing becomes more and more popular because the huge benefit of small local bank financing is that they are not constrained by the limits, regulations, and conventions of the conventional financing world. Because a small local bank, we're talking about, you may live in, Littletown, Arkansas. So this would be like Littletown Community Bank. Usually they have one, maybe two branches, things like that. So you have a small bank, I'm not necessarily referencing a credit union, even though a credit union can sometimes operate in the same type of manner as a small local bank. But a very small bank, maybe one, maybe two, maybe three branches, usually not more than that. And these types of institutions are interested in lending in the community. They're also interested in returning a good profit on their profit and loss statements, and they think differently than the giant banks like Bank of America or Chase or things like that have thousands of branches set up all over the place. And they also are a lot more flexible because what they do is something called portfolio lending. And portfolio lending means that they take money that they have on hand or that they have access to, and they lend it out. And then they do not take those loans out, those mortgage loans or investment mortgage loans, and package them up and sell them on the secondary market to Fannie Mae. They don't do that. They keep them in portfolio, and then they collect the interest on them each and every month and realize a profit that way. If you think about it, the fact of the matter is that whoever's collecting the interest every month really does get the lion's share of the profit over time. The lion's share of the profit is not in setting up loans and then parsing them off to somebody else for a quick buck. So this does, from a long-term investment perspective, really does make sense. And they are in that mindset. So that is one of the benefits there, because now you don't have to deal with things like all of the regulations that come with conventional financing. You don't have to worry about the for-property thing. If your small local bank decides that they want to make the rules and decides, hey, they look at your business individually, say, hey, this makes sense for us. We've done a few deals with this particular investor and things have gone great. We want to do more of this type of business because it's so working out great for both of us. They don't have any type of limits. So if they say, hey, let's do 20 properties, you can do 20 properties. Sometimes their limits are not, number of loan limits, but simply the amount of money that you can borrow. So let's just say a bank has a total amount of assets of $700 million. Now 10% of $700 million will be $70 million, and then 1% will be $7 million. They may have a rule in there that says one investor cannot borrow more than 1% of the total assets of the bank, so you would be capped at $7 million. Now, if they only had, $80 million, you might only be able to borrow up to $800,000 max. And that would be because of the rules and conventions that are set up in the actual structure of the way that the banks work. So that, like I said, you're going to see if you can set up a relationship with your local bank. Sometimes you're speaking with the president of the bank. Sometimes you're speaking with a managing director, somebody that's very important and has the ability to make the decision on whether or not to take up your particular loan where it comes to your real estate investment financing. They're able to make up pretty much their own rules. Very similar to private money, in that if they want to loan on the appraised value, they can. If they want to loan for different terms, they can. If they want to vary the interest rate, lower your points, they can. And so these are the types of things that make small local bank financing very attractive. Okay, so let's go over this real quick, wrap it up. The pros to small local bank financing is that once you have developed a relationship with your small local bank, you can get funding that other people pretty much wouldn't. You can get hard money style funding where they give you all the money for the purchase, all the money for the rehab, all the money for the closing costs, and they do not require you to put large down payments. All of these types of things. They don't charge huge points though like a hard money lender, so the money is actually more affordable, and that means the bank's taking less of your profit, you're keeping more of the profit in your pocket. The negatives or the cons of this type of financing source is that it is relationship based as well. So you do have to take steps and invest time in going out, finding the right types of local banks, sitting down with a business plan. Sometimes you have to create a new business plan, structure it, and talk with people, explain what you're trying to do, and try to communicate where your business is, where you're wanting to go, and exactly how you can benefit each other between you and your bank. So that pretty much wraps it up for small local bank financing. Next episode, we're going to be talking about seller financing. And all of you that have been wondering and saying, man, how are you going to help me out if I have rough credit? Seller financing is the key. Make sure you stick around and don't miss that episode. I'll see you next time. Thanks for watching.